So now tell me when you see it live. So confusion, I guess, a little bit over what page we were going to do this on with the encoder that YouTube provides us. So hopefully people can find us versus the event page that we created, which I've never used before, so that's my fault. So please forgive us. First time we're doing this. All right. Is anyone with us? Do we have any people? No. Okay. Um, so let me just ask, is Renee Sargent on? Can she ping you? Do you have a way to see who's on? We've never done this before, so bear with us. Okay. Is Happy Cakes Renee? Okay, so I'll answer this question. She emailed to us, or he emailed to us. After 2008 market crash, precious metals, along with mining shares, sold off due to liquidity reasons. And they had gone up a lot since the early 2000s. Now they're under-owned. Again, what's your feeling this time? Will mining shares, again, take a dive during the next sell-off? Is it different this time? I don't know. I mean, there's a possibility, like I said in the live yesterday, that you could be in a situation where if you go into a kind of a panic liquidation in stocks, or maybe even more so like an after-the-fact dynamic where stocks fall, the Fed addresses it, and it doesn't work, the address, and the reflation doesn't work. And, this becomes an issue of math. When you're talking about, just look at any chart of the S&P, any chart of the Dow that I put in that live. You go back and look at the 1987 crash. You can barely find it. So when you talk about the mathematics of where you are at 30,000, at 27,000 on the Dow Jones Industrial Average, 2,700, 28, 2,900 on the S&P, the dynamics, first of all, of a 30% move are much bigger in dollar terms, in points and in dollar terms. Less so involved in percentage terms when you get these swings of 3%, which seems so big. It's like an 800-point move, and everyone freaks out. It's 3%. That's really not that big a move. It's certainly not a crisis-like move. So my point in terms of that is we've come so far that my fear would be you get a decline in equities down, let's say 30%, because that's where some of the Fibonacci's begin. We're not even talking a deep correction. That would be something of a normal correction in terms of what we've had since 2009. And if you get that, I think, this brings the Fed in. You get QE, and, who knows what they could do. They bring rates down to zero, or they try and, reinstitute QE. My fear would be that you have to, with $23 trillion in government debt, with consumer credit was around 1.7 trillion in 2009. It's 4 now. So you're talking about having to double all the stimulus numbers to get the same impact percentage-wise relative to the supply of paper that you're trying to offset. That would be your debt deflation dynamic versus the reflation you're trying to accomplish. So is the Fed going to be able to print $8 trillion? They're going to expand their balance sheet by $8 trillion, 9, 10, 11 trillion? I think that's going to be problematic. And therein lies maybe some of more of the risk of what your question pertains to. If you get that kind of situation and people are down 30% of their stocks and gold has continued higher, that's maybe when gold takes a hit because people are looking to basically get liquid and to get dollars. The other thing would be, if things came off hard and fast and everything was down, like in 2008, it could be the same scenario where gold goes down, mining shares go down, but less than everything else. So it's still that store of value, not to say it insulates you from losses. So this is where it gets tricky with trying to determine what every type of customer out there is trying to accomplish. Are you trying to protect your wealth? Are you trying to grow your wealth? And there's two different strategies that you would use based on those answers. So my thought process is I'm a trader. So this is what Weldon Live does. Weldon Live says, okay, look, we take profits on gold. We want out. So we're not going to sit through a 25% decline in gold because I think we're going to be able to see that scenario setting up and coming. We have in the past, and we waited for that dip, and we bought the hell out of it, and that was the right move. So, yes, it could happen again. I think the chances are a little bit less in the sense that this is so global and so big that, whatever central banks bring, even if it doesn't work, it's kind of going to be sensationalized. You might get a pop. It's psychology, and it doesn't work. Where the things where the spike on the bailout gets you back to the breakdown pivot, and then you have a range, and you go sideways, and you go nowhere for a year, for 2 years. To me, that's a more likely scenario than almost any scenario, and that's kind of dangerous. Now, the other thing I would say, kind of contradicting myself, but this is what we do, create all these scenarios because we don't know what's going to happen. And one thing I can tell you from doing this for so many times and seeing this back to 1987, we were short the stock market in 87, we were short the stock market in 2000, we were short the stock market in 2008. We've caught every major down move. It's one of the things we do because we're kind of part of what the fund business that we're in here is to seek high rewards, take a little higher risk, but to make sure that you are positive when the S&P is negative. So, that's kind of part of our mandate, if you will. Within that context, I'm forgetting where I was going with this, but in Weldon Live, we're not sitting through a 25% decline. We're going to try and wait and buy the dip, or we're going to be short gold, or we'll be short S&Ps, or long bonds, and like we have been recently. Short the Dow. We're actually short the Dow Jones futures, long the 5-year note, and long gold. And, that's worked out really well here. Long Australian bonds. We've had some other peripheral positions that have paid off. So, yeah, could it decline 25% if you get a mass, bailout type of thing? Oh, the other thing I was talking about is you can't underestimate the central banks and how creative they've been, how aggressive they've been. A misstep I made, we were very profitable in 2008, and we gave a little bit too much back in the beginning of 2009 after the St. Paddy's Day monetary massacre when they announced TARP and TALF and QE1 was St. Patrick's Day of 2009, and we wanted to sell the big rally because we thought, the Fed's not going to want to be aggressive enough. They're not going to want to come with QE 2 and 3. Even though that's my whole mantra, and I wrote it in the book. It's like, he said they'll do whatever it takes. And in that case, they did. And we underestimated that. So, it's a push and pull. We're not always right. But I think in this case, the risk really is that they try something that they think will work and it doesn't. And then what? And then this is where I said on the One Real Vision video, that MMT, the modern monetary theory, right, has credibility. And I took some heat for that comment, and I understand the heat because, that's not credible from an academic standpoint. What's right, and in terms of theories and academic and what should be. That's not what we're dealing with here. You can't talk about what should be and what's the right thing to do and how do we fix this. There's no fix. The last time we could have put in solutions that might have potentially been, some solving of some of these problems would have been, in my mind, 1990. And we didn't do it. And since then, since Greenspan took the Fed funds rate to 3, when inflation was 3, and got blasted for it. Each step of the way, it's been something that is unprecedented that I've called, and not to be full of myself. It's just one of these things. We dig so deep, we kind of see these things, and I come from a great pedigree of people that I've worked with when I was younger, that really taught me to think all the things out, kind of envision the scenarios that might play out, and then kind of navigate it. And in 2009, we said, Greenspan's going to basically take the real Fed funds rate to 0. And you were blasted. It was monetary heresy. You were a nutcase to think of something like that. It's exactly what happened. 2007, I wrote in the book, which I started writing in 2005, called it Monetary Armageddon, that the Fed would monetize Treasury debt, print money, and just put it in a system and take the Treasury debt on their balance sheet, right? And we got blasted for it. And I remember promoting the book on CNBC, and Joe Kernan and Squawk Box, the whole crowd. Mark Haynes was the anchor there, and I was bullish on gold, and it was trading for like 4.25. And I went on, I said, well, you're going to have a consumer problem. You have a housing issue, and consumers going to, take a dive, and there's going to be a consumer credit where the consumer contracts. And the only way the Fed's going to be able to reflate out of this is to buy Treasury debt, monetize Treasury debt, print dollars, and create take it on their balance sheets and try and create inflation that way. And the people on the set looked at me like, I had no head. And what was funny story, I mean, as an anecdote, I mean, I left the stage, right? And Mark Haynes just hated everything I had to say. It was just, you could just see the guy was so uncomfortable. And I have a lot of respect for Mark Haynes. So I go back to the green room to get my stuff, and they have the TV on there. And Joe Kernan is just bashing me. I don't understand these gold guys. What a bunch of kooks. That's what you call me. Call me a kook on freaking, in front of millions of people on TV. So interesting story is after after 2009 and after QE, I'm back on and not on Squawk Box. They never had me back. That was the last time I was invited back. But I used to go on the show at 11 o'clock, and it was Consuelo Mack at the time. And I ran into, no kidding, walk into the men's room, not to be too earthy, but I mean, walk into the men's room, go into the bathroom. They only got, the two little urinals there, and who's standing there? Joe freaking Kernan. So, I mean, I'm 6'10", I'm 300 pounds. I look like a professional wrestler. I'm big, I'm wide. So I stand up, and I mean, he just looked up at me. And I looked at him, I go, "You don't remember me, do you?" And he just had a blank look on his face, and I shared the story with him, and he ended up inviting me to play golf with him by the time we left the men's room. So my point in all that is you can never say that nothing is possible, that the Fed can't do something. So MMT, is it credible? It's credible because they believe it's credible because they're going to do it. It's not credible in an academic sense, but that you got to throw that crap out the window. It doesn't matter whether it's right, wrong, credible, or rational, or any. None of that matters. What matters, one thing: pain avoidance, avoiding a debt deflation. That's it. And they will do whatever they have to. And MMT is real. And before I met Warren Mosler, who was kind of considered the godfather of MMT, when I was working in St. Croix, he was there, and we got friendly, and this was his big theory, and I kind of looked at him like, you're out of your mind, dude. But he was also in the back rooms when they negotiated Maastricht, the Treaty of European Union, 1990, and he told me, he goes, "Greg, you have no idea." He goes, "The 60% rule on debt to GDP ratio was a random number. There was no studies, no reason. It was just a number that they picked because it sounded good and it was close enough to 100, but far. I mean, so again, there's outside of the theory, some of the Rogoff and so, some of the studies, there's a whole bunch of them about crisis, and above 100% of debt to GDP is a situation where you start to run into problems, especially if your debt to GDP is rising and it's above 100%. Well, look how many countries are in that situation. Do we see crises? No. When the Fed pumps in $4 trillion, do we see inflation? Yes. In the asset markets, do we see price inflation, wage inflation? No. It's not the same. So, I wrote in the book, I called it Monetary Armageddon. I think I even said this in the video we did. It's like the Hollywood movie with the two guys that have to turn the keys simultaneously to set off the nukes, where they buy every treasury bond ever printed, wipe it all out, all right, as a fiscal stimulus. And to say that's ridiculous and can't happen is to say the Fed will never cut real rates to zero, to say the Fed will never monetize debt by buying treasury bonds, and to say that sovereign debt will never be a negative yield. All of those things have happened. So to say that MMT and Monetary Armageddon is ridiculous and has no credibility, bullocks, I say. It has a lot of credibility because they think of it and they will do it. That's why it's credible, not because it's the right thing to do or academically correct. So that just, I think you have to keep that in mind, that you can't underestimate how powerful the central banks can be. I just think you run into a period where the mathematics make it increasingly difficult to pull it off because of the political will, because of central banks having the stomach to print that much money. I don't know. I really don't. So my fear is what they do isn't going to be enough, and then it fails, and then you basically have a stock market that goes nowhere for a while, and that's a bad scenario because you need growth to service this debt. You will kind of slowly, it'll be like quicksand into a debt deflation. So, I don't know. That's what makes it so interesting to get up every morning and see what's going to happen because we just have no clue, and we try and theorize, all the things that could happen. I think the next big thing is still the ECB. The next big risk is the dollar. To me, the fact that you have no forward guidance, the dovish on the dollar, it leaves the dollar where it is, where a dollar rally begets its own problems. And maybe a dollar rally begets its own problems, or a dollar rally tells you there's a problem with dollar debt. And that is a very real risk that could blow up the whole thing. because if the Fed doesn't deal with that in a preemptive and aggressive way, if and when it happens, and it's happening right now, the fact that dollar's at 98, you see the CRB breaking down, you see crude, on the verge at 50-50, all the things we had in the charts in yesterday's live, those are the things to watch, and those are happening. And mortgage spreads, I got a call from a mortgage broker down here in Florida. He priced out a refi at 4.25 last week, and he's already saying now he'd be lucky to get it 5%. Are rates rising so much? No. But when you get fears of recession, the lenders start to pull back a little bit. So you notice the mortgage treasury bond spreads have blown out, and the lender's less willing to make a loan at 4.25 now than he was a week ago. Because now it's the yield curve has steepened, and all of a sudden this epiphany that you could have had any day in the last since March came this week. So I don't know. We'll see how it all plays out. The other question that was someone sent in, just to address the people that took the time to write in, I don't know how to answer this question. My income is such and such. I have such an amount of money with most of it in gold, or at least half of it in gold, some of it in silver, and the rest of it in a CD. Now, you need to use to hedge, and should I break the CD to hedge? I'm not sure why you want to hedge, and I'm not sure what the purpose of hedging would be. So, and using the DGLD. I mean, if you own this, I don't know why, you think the timing is right to hedge. I don't necessarily see that. And why the need to hedge? To me, this is, these investments are for a purpose. I'm not a big fan of hedging anything, honestly, unless you're a commercial account. That's what hedging is designed for. And it's funny because I used to work with a pretty good trader, was one of Lewis's traders, actually, back at More Capital. And it was a guy that would, buy gold. And then he didn't want to dump his gold position. He'd go, let me hedge my gold position by selling platinum. And it just got messy. And it's like, why? Just dump your gold or hold your gold, one way or the other. Why hedge? Especially, I understand in terms of coins, it's a little more difficult. I get that. But to me, the time to hedge is not now. The time to hedge would have been, like early 2012. You would have hedged, and you probably would have gotten out in fourth quarter of 2015. You would have gotten out of that hedge. So right now, I'm not looking to hedge anything in terms of precious metals. And I understand why you're asking that question. I don't think the time is right. And, I guess the only way I would want to even hedge would be someone that owned physical gold, bars and coins. Yeah, but not here. I don't see it. So any other questions? Okay. Yeah, it could happen. Our first upside target taken out, 1445 was 1505, and we hit it. So it could pull back. Dollar could break out. Could be some fears around the dollar. Could get a trade deal. I don't think that's going to happen. But if you do, there'll be a psychological pop. I don't think that's going to last. It'll be very short-lived. I almost want to see if you get a trade deal, the stock market rallies big, and within 48 hours, I'm probably looking to sell it. So, yes, it could pull back. But I think the question to be asked is, so do you want to sell your gold? This is why we swapped into silver, because owning silver at this point, you have less downside. It hasn't moved as much. So I think to me that was a good move. And, do I want to bail on silver here? No, absolutely not. Could silver pull back to 1620, maybe even as low as 1575? It could. In terms of gold, I think, anything to me, anything below 1390 is a gift. And I'm not sure you'll see it. Could you go as low as 1290? You could. I don't see that happening. I really don't. Lightening up positions here, sure. But keeping a core position always. I want to be long these because my question, getting back to my kind of, how I would couch this would be, the downside in gold is what? Maybe $150? The upside, short term, is to 1800. So you're 2-to-1 upside, and to me, I don't really want to have to lose my position and be scrambling back in on some news where the thing gaps up, $30. So, as long as the indicators are bullish, as long as the fundamental backdrop is bullish, as long as psychology is not prohibitive, which I don't see that is prohibitive here. I don't think everyone's plowed into gold, whether it's this huge long position where you're going to dump this thing and crush everybody. Not yet. So I understand, lighten up maybe if you feel uncomfortable. This is a personal choice. Could it decline? Yeah, it really could. It's kind of in that phase, space, time and space is kind of there. But I think that will be, short-lived, and make sure you get back in if you do that. We address that by swapping our long gold into silver at really good levels, so I feel pretty comfortable just holding my silver. Well, we haven't seen it lead to inflation in a long time. Fiscal is going to be tough because you have election coming up, and what is Donald Trump going to go out and put forth the fiscal program that's going to get past the Democrats? No, not happening. So I think the time for that is past. It's going to have to be after the election. So no, not in the U.S. That's not true other places. China, for sure. Japan, probably. Europe, absolutely. So will that lead to inflation? No, not in any of one of those places. If anywhere, China, you always want to watch Chinese inflation, but also understand that Chinese inflation data is measured and calculated different ways than in the West. It's much more heavily weighted in food. So yes, fiscal in other places outside the U.S., maybe in the U.S. later. Will it will it stir inflation? No, but it's bullish for gold. Absolutely bullish for gold, because what it does is continue to blow out debt. This is still a problem. I mean, this is why, to me, gold is so bullish right now, where it's not responding to the fact that the dollar is well bid and hasn't cracked at all. Now, the dollar's not appreciating on any kind of longer-term rate of change basis. So, but if you look at the chart, the one chart I think is really telling, which is the dollar-adjusted value. The gold-adjusted value of the dollar index. I mean, that's broken down in a big way, and that's a telling chart. Right now, it's all gold. I think it will be dollar, but how that plays out in terms of again, gold right now is what it's telling us, because it's rallying in every currency. The yen and the Swiss franc have been the strongest currencies. Gold has broken out against both. So gold is the strongest currency in the world over the last couple of months, and what that tells me is that fiscal expansion, which will come certainly in Europe, no doubt about it, is bullish for gold. Why? Because it only continues to kind of foster this. What the hell? I mean, what are central banks, man? They can't just keep doing this. Can't just keep printing paper, at will. I mean, talk about helicopter money. I got asked on a radio show the other day about helicopter money, and is that what Europe's going to deploy? And that's exactly what they're going to deploy. And that is, to me, that is bullish for gold. And when you look at, $8 trillion in U.S. sovereign debt versus $23 trillion in sovereign debt, $8 trillion in sovereign debt when gold was, $550, and gold's more than twice that now. That speaks volumes right there. So yes, fiscal spending overseas. No, not necessarily inflation, but that doesn't mean it's bad for gold. Continues lower. I mean, if you kind of look at the yield curve and some of what I talked about on the yield curve yesterday, it's a tougher call from here for sure. But one of the things I've been saying for a couple of weeks now is the fact that the Fed gave us no dovish guidance was so bullish for bonds. And what's funny is bonds got whacked that day, and I was like, this is not going to last, because this is so bullish for bonds that Powell is sticking with his hawkish rhetoric. And like I said yesterday, he's not the same type of master puppeteer that Yellen and Bernanke and Greenspan were. He doesn't have that same, kind of nuance. And I actually, I'm always talking to myself in the mornings and asking myself questions. And the question I was kind of asking myself this morning, literally, was, does he really, he could be a situation where he just doesn't care about the markets, where he is so myopically focused on, I can't let the 1970s happen. Not that we see that anywhere, we don't, all right? But that he is going to do what he feels. Because let's be real, the inflation numbers are not falling off the face of the earth. Every treasury yield is below the level of inflation, all right? Now, you need that in a stimulative environment, all right? But the Fed is not there. And so the market is there, the Fed isn't, and that's a problem. If the Fed sticks to their guns and basically says, why are we going to go cut? Raul, I respect the hell out of Raul Powell, and he's a buddy of mine, and we hang and stuff, and we kick it. He's been really bullish on the dollar this entire time, and I've kind of been bearish, and frankly, we've both been wrong. Dollar's gone nowhere, right? But to him, he's like, the dollar is absolutely, going to bust out to the upside, and this, that, and the other thing. And it's one of these things where, the Fed. And he's talking the thing that I wanted to point out. He said yesterday that he thinks the Fed should cut 50 basis points in September. They're not going to do that. And they're not going to do that because inflation is not 50 basis points below the current level of Fed funds. All right. I mean, Powell, has said we have an easing bias, but we want to kind of, to me right now, they're trying to maintain neutrality because inflation is not affected yet. And I think that's a mistake because by the time you see the inflation reading, it's going to be too late. And this is about the markets. And the markets deflating will cause the economy to deflate. It's not the other way around anymore. So I think that's an important distinction that I'm not sure Jerome Powell, and I have to call him DJ Rome. He's spinning a whole different type of music. This is EDM. People in Washington, they're used to their rock and roll. They're not ready for EDM, man. And Jerome Powell's a different cat. And so my fear is that maybe he's just like, I don't care about the markets. My mandate is not about the markets. My mandate is employment. And now he's looking at such a backwards indicator. Another mistake. Okay, he doesn't have the same, suave in terms of the markets, in my opinion, as some of these other guys did, or at least surrounded by the same type of people that maybe, Bernanke and Yellen were surrounded by. They were real kind of market, had real market, acumen. So maybe he just doesn't care about the markets, and that's the most dangerous thing. I mean, if he's like one of these, the markets could afford a 20%, 25% hit, then he's missing the boat on the whole thing, because you probably know my view on this, and if I'm repeating myself, I apologize, but it's so glaring to me. It's kind of why we have really accelerated our marketing efforts, why we're accepting new money for the first time in like forever, because in 2006 and 7, you had, the consumer households borrowed money against an asset they were convinced by the Fed. Remember the Greenspan put on housing, all right? I'll buy mortgages and I'll protect mortgages. All right. The public is brainwashed by the Fed into thinking home prices will never go down. So they borrowed like crazy against their homes. And what happened? We know what happened. All right. You have the same situation now. More subtle, but it's the same. And it's linked to equities. All right. You see this huge rise. And I mean, look at the percentage gains. I mean, they're enormous. And look at, everyone's passively invested. Everyone owns it. I mean, everyone's plowed into stocks. And because you got that feel-good factor, you got the wealth effect, that's when you see consumer borrowing is taken off again. And to me, it's the same thing. You have borrowed against unrealized paper profits in an asset that the Fed has convinced you will never go down. And if it does, we got your back. What if that's not true again? And what if equities go down and stay down in our worst-case scenario? And that's why it's the worst-case scenario. Because it would kind of, it would be a different type of thing. It wouldn't be the same thing. I don't think it would be just an utter collapse. I think this could even be worse because it's one of these longer, slower, drip, drip, drip. You bleed to death instead of being shot in the head, So, I don't know. I mean, it's going to be interesting to see how all that plays out, but hopefully that kind of addresses some of the question. On what? I mean, I like the acquirers. I think okay, so we did the special on gold a couple days ago, so you guys didn't get to see that. And if you sign up for a free trial, you'll have access to that. We did all the mining shares. My thoughts on every one of these. So, I'll answer the question. Barrick and Newmont, I mean, they've kind of underperformed, all right, especially Newmont, after outperforming. But I like the acquirers because what they're doing is they're accumulating resources in the ground, and I think that that's a really smart move. So I like those stocks. I think the price action is not bad. You have kind of a flat top on Newmont. Barrick's kind of already broken out, the new Barrick, the new rejigged price. So I like them. I like Barrick. I like Newmont. They're among the, top maybe 5 to 10 that I would own for sure. I would want some of the smaller ones, just to throw them at you. I mean, like Kinross. I'll tell you one. I'll give you a pick. Sabina Silver. I think it's SBB. This, to me, it's like $1.70. And this thing's been all over the place. And every time it's been below $1, it has been major value. In terms of the company and so on and so forth, I'm not making a judgment on it. From a purely technical price action dynamic and a relative play, Sabina Silver is really cheap. So you have Kinross is a good one. There's a couple more that we like in that space. Anglo Ashanti would be another one. So, I kind of like have a mix of lower price, maybe get more, some more alpha on the upside or some more, return versus having the accumulators that have the chance to be just power uptrends that are, really, really solid and tight and really never give you too much agita. What else? Right here in my cave here in southern Florida. Um, I mean, again, this is why I want to be a trader because you're always going to have opportunities in currencies and commodities. And to me, you can play the bond markets, and I think you're going to have great opportunities at some point to be short some of these bond markets. I mean, I still think there's bond plays out there, particularly in Europe, that are going to play big into kind of where those blow-ups come from and where this thing devolves to would be reversals in bond markets, particularly in Europe first. So I think the next, one of the next potential big opportunities is in the bond markets and more so the short-term interest rate dynamic in the Euribor deposit rate futures. But, I mean, good place to hide. That's an investor question, and that's just so tough, man. I mean, maybe no place to hide. And then you say you want to buy cash. What currency you want to own? None of them. And that brings you back to gold. So it's not like I'm a gold bug. It's just when you slice and dice, and you come down to what's left, I guess you do the Russian dolls, what do they call those? And the last one's gold. And, I always liked, if you, maybe none of our listeners are old enough to remember, but one of my favorite guys, Jim Grant, okay? I used to write for Jim Grant's website when he tried to do this, online, which didn't really work out because he's not an online guy. And, if you remember, he had the pyramid, right? It was like the food pyramid, only investments. And at the top, little triangle of pyramid was gold. And I think that's as good as anything out there to kind of answer your question. Where do you hide? You hide in the place that, and I'll throw something at you that may sound esoteric and off base and everything, but, just think about it. Just have an open mind and think about this. Why is gold so valuable? I mean, I remember when I got my job on the COMEX. I was 23. I was working in telecommunications. I went to visit a friend of mine, right? He worked on the COMEX. And I walked down there, and trading was still going on. They brought me on the floor for the last 15 minutes. And then he had to do his write-up because there's no computers. Everything was on little pieces of paper. There's paper everywhere. I mean, it was a zoo. How people kept track of what was going on was just an enormous mystery to me. But I remember asking him, what supports why is gold here, and why is gold even worth anything? It's worth something because it's one of the rarest things in the universe. Gold is created at the very end of a supernova, where it creates the most precious, minerals, the most precious elements, really, in the universe. So, that's why platinum, palladium, I mean, it's kind of a scale. The more rare it is, it's because of the universe, it's because of physics, it's because of creation, it's because of billions of years. So, to me, and that brings you to Bitcoin. And, I love the Bitcoin guys. And there are times we've been bullish on Bitcoin. Bitcoin serves a purpose. To me, it's a commodity, okay? It's a commodity. It's not a currency. People that say Bitcoin's a currency, that's such crap. It's not a currency. And it's fraudulent in the sense that Bitcoin is a gold coin with a dollar sign on it in the shape of a B. I mean, come on. I mean, you are trying to tell people you're gold and a currency when you're neither, okay? However, having said that, that's not to mean that it doesn't have value, and that's not to mean that there's not credibility to all the things that some of the, Bitcoin naysayers tell you. There's credibility to a lot of that. I think in a case of where you see places in the world where they can't use the local currency, okay, like Venezuela, okay, where it's either you get dollars or you have Bitcoin. Well, Bitcoin's, frankly, in those cases, maybe easier to get than dollars. So it serves a purpose, it has a place, but it's a commodity to me. It's a token that has some use in a transactional, whether it be nefarious in the netherworld, or whether it be in a case of where paper currencies are out of favor, and if you don't have dollars, you're out of luck. Well, now you have an alternative. Would be Bitcoin. I'm not even going to say cryptocurrency because they're not currencies. I'll never call them that. And we've been bullish on Bitcoin, it kind of in this whole situation when Venezuela started to come unglued. It was like, this is kind of bullish for gold and Bitcoin. There's no reason they can't coexist. But when you come down to it, what is Bitcoin? I mean, you can't hold it, all right, like you can gold, all right? It's created in another world by human beings, using, so it's mined. I kind of like that thought process, but it's not naturally created in the universe, and that makes it less than right off the bat in my mind, relative to gold, which is not only rare on this planet, but rare across the entire spectrum of the universe. So to me, that's something that people don't always kind of think about or, have in their their thought process when they decide investing in these things. And that's why I still think, even though platinum as an industrial metal, has its risk, platinum is more rare than gold, and it's $600 cheaper. That's something I don't think is going to last. So those are some of my thoughts around that. Where to hide? Yeah, I mean, good luck finding a place. I know smart people hiding in ranches in Montana. I mean, you remember the show Doomsday Preppers? I mean, that was a great show. I know people, smart, rich people that have done that. Because if you look at the social situation, and I could blow your minds with stuff in terms of science, about some of the science that's going on this planet that is causing some of this polarization of everything. You see it on Facebook in terms of each side is more stretched and more extreme and more radical. It's the left is more radical, the right is more radical, everyone's extreme. And there are reasons for this I won't get into because they're way out of the realm of what we're talking about. And but the degree to which this is probably only going to get worse, and the degree to which you could make a hard case that kind of a civil war to end all civil wars. If you get a collapse in the markets that causes an economic situation that's pretty bad, this will precipitate the next level of all of this if you want to play doomsday scenarios, all right? I don't think I'll live to see one, but it could happen tomorrow, which is what makes it so scary. And that is where you have like a civil war to end all civil wars. That is a race war, a class war, a religious war, and a political war, all wrapped up into one. And that is not as absurd and ridiculous as it sounds. So then finding a place to hide will be even more difficult. Okay, we don't really have a member center, so just not to mislead you as to what we offer. But in the live, we cover everything. We cover all those things. Doesn't mean I cover them every day. I mean, we might not talk about crude for 2 weeks because there's nothing happening in crude. I could talk about crude 6 times in 2 weeks when something's happening in crude. We cover all of that. Foreign exchange, fixed income, stock indexes and ETFs everywhere. The precious and industrial metals, the energy, and the agricultural commodities. So we cover pretty much, all the sectors. We offer trading recommendations in anything and everything. I mean, to me, this is why this is, great to kind of approach it this way. Because the more things you can watch and the more things you can monitor, the more opportunities you might have to catch a big move in any given year. Because there really aren't that many. If you slice it down, you get, 3, 4, 5, 6, 7 big moves in a bunch of markets in any given year. That's what you're looking for. So the broader my swath of things to watch: cotton, sugar, soybeans, Japanese government bonds, the yield curve in Australia, really the Malaysian ringgit, South African, stock index, all these things. The more things we can watch and monitor and have, really our finger on the pulse, the better opportunities you have to catch a big move in any given year. And that's my goal, is to make sure that we don't miss the biggest moves of the year and that we make sure that we capitalize on them for our customers. And, I can tell you this, Weldon Live has paid for itself for our customers every single year for the last 20 years. So, and we've never had anything but high praise in terms of, wow, I made so much money. One guy just one guy just emailed us this week and said, this is the best money I've ever spent. It seems it's like, it's weird because we used to charge, $15,000, $20,000, $25,000 to institutional desks to, for what used to be Weldon's Money Monitor before we changed it to the Live to make it comprehensive, more affordable, and cut the price. And, people are like, man, that price is pretty high. And in this day and age, when you got Twitter for free, and you got YouTube for free, and you got all this stuff for free, it seems high. But on a relative basis, a couple $1,000s is nothing compared to the things that we talk about and the opportunities that are available, to us, to you, through us, in the markets. That couple of $1,000s is pennies relative to what's out there to be taken. Yeah, that's a great question. And, there's no black and white answer. The pros are the GDX, you have exposure to everything. Okay. The con is the GDX, you have exposure to everything. So, and I'm serious. Because there will be times when you being focused and having, a couple of the right shares will be much better than owning the GDX. On the other hand, having the wrong shares is much worse than the GDX. To me, the answer is how closely can you follow these things? All right. The less closely you can follow them, monitor them, trade them, be in and out, understand them, research them, and really follow them. And the companies are tough because there's so many more things you have to know in each company as opposed to the GDX. So it really comes down to how involved are you? What depth of participation can you have? The more depth, the more research, the more time, and the more passion, the more better off you would be in the individual shares versus the less time you have, the less anxiety you want, and that points you to the GDX. Yeah. All right. Thanks. Yeah. Yeah. Okay. Great. So, please come try the work for 3 weeks. We don't call you. We don't take credit cards. I don't believe in that. The work sells itself. We don't sell you. I'm not coming hard sale, calling you 9 times. We'll call you once after your trial. If you don't call us back, we're not bothering you. I just don't believe in that, and I don't have time for that, man. You see what I do? I do this by myself. It's me and Caitlin. That's it. So everything you saw yesterday, that took me, hours and hours and hours of work, especially after Microsoft wanted to update my Windows and blew me out after I wrote the first 4 pages of that thing yesterday morning. Man, was I not happy about that. But, we dig in, and this is what we do every day, and I love it. I absolutely love it. Plus, I live here in South Florida. I'm very lucky. I feel very grateful. I feel so grateful to have people like you that want to know what I think. You have no idea how much that touches me, and it really, really makes me feel good, and, I aim to deliver. I really do. We bust ass here, and I'm passionate about that, and it's just me. You get 100%. We don't hold back. Nothing. So, thank you. Good to go? Time to hit the pool? All right. All right, good. All right, thanks, everybody. And thank you, Caitlin.